nearly 10% from recent lows. So what does Macquarie say? It says company is well positioned to capitalize on India's long-term growth potential, and it's a diversified port and cargo mix that supports the resilience and integrated nature of logistics offering should aid further customer lock-in, and visibility of healthy recurring operating cash flow remains high for Adani Ports. Also, YTD, that company has reported cargo volume of 409 million tons versus FY25 guidance that company had given. It was in the range of 460 to 480 million tons. So on cargo volumes, still it remains around 70 million tons below the FY25 guidance, but Macquarie remains positive on the stock.
All right, so Sudarshan, thank you very much for that. Adani Ports will also be on our radar. We'll kickstart with what the implied open was indicating, this 100-point gap down. The question is, what happens after that? Will this market have the appetite for some recovery, given that we've already, we were way ahead of the fall? Our markets, our indices are down anywhere between 15% to 25%. The US has started faltering only now. So that's the question. But yes, we have the current challenges to navigate, which are, of course, all these tariff concerns and the US concerns. So it's an across-the-board sort of a gap down that we're starting off with. It's not any particular sector. Mid-cap index is also all set for a lower start by almost 1% lower. The bigger question is, of course, what after the gap down? And if there can be any leaders emerging, will banks come to the rescue? Can Reliance come to the rescue? Let's find out. Okay, off we go. 122 down, 130 down on the Nifty, which is a cut of about 0.6%. IndusInd Bank straight away down 10%. It's locked at that 10% freeze right now, not moving at all. So let's see, what transpires. Absolute lock at 10% on IndusInd Bank. It's not recovering. Anyway, let's look at what else is weak. Technology is, of course, the Nasdaq, wins have hit us as well. Infosys, Wipro, HCL Tech, Tech Mahindra, TCS, all standing in a line, or falling in a line, I should say. Trent is weak, JSW Steel is weak, Tata Consumers, Bajaj Finance. It's a wide sea of red. Let me actually look for any of the moves on the upside. And ICICI Bank is finding some takers. So it's a very strict flight to quality kind of a morning. Very little green on Maruti. Beyond that, I can't count much at this point in time. Some little trickle of green on Bharti Airtel. But aside of that, everything is down. The large caps are trying to fight back. Keep your eyes on L&T, ITC, Lever. And let me also pull up Reliance. Reliance is still down. So these big boys are very close to the even-Steven line. Let's see if they manage to make it. But right now, no doubt about it, it's a down morning. The Nifty is down 130 points. Mid-cap index is sliding even more, about 1% lower. And the Bank Nifty is down 0.5%.
On the Nifty, Sudarshan had given us the level, 22,250. That's the important mark you need to track on the downside if you're going to be adventurous and go in there and buy the Nifty. That's important. The Nifty Bank, though, after moving to around that 47,800 odd mark, which it's done numerous times in the last 7 to 8 trading sessions and bounced up there, it's seen some kind of buying at that level. So 47,750 to 47,800. The Reliance, that's the one that will need to perform. As of now, it's holding above its 20 DMA. The 20 DMA is at around 1,216 rupees. So we're still a little 1.5% away from those levels. That one will have to put in a good fight and support the Nifty Bank, because for the time being, you have the tech stocks that are getting it on the chin. Let's pull up a few names. You have HEG. There was some positive news flow overnight with regard to value unlocking in one of their subsidiaries. HEG, the stock is still down close to 100%. So the street for the time being is ignoring any kind of good news. The other one was BEL. They won an order as well. So that as well should come up for you on the screen. Let's pull up Max Financial, because of the NCLT verdict that came in favor of Shriram. The sheet sees this as maybe, in fact, it could be the green signal for Max Life to merge into Max Financial as well. So that could be one of the reasons that stock is outperforming in today's trading session. There could be various challenges, but that's one of the few stocks in the green. The breadth of the market, that's worrying. We're back down to around only 250 stocks that are advancing. You'll want that number to gradually, improve by year on. But par for the course, I would say. 100 points yesterday down. Today, another 100 points down. Maybe some part of this overnight weakness has got factored in, at least for now, with this 250-point cut.
Well, it's a full risk-off screen right now. That advanced decline ratio, 1:7, tells you the picture. On the way down, Jyoti CNC. Now, this one's been an outperformer. It's up 15% in this month, in the month of March. Since the start of the year, the stock has also been higher. 47% gain in the last 1 year. But today, the stock is seeing some amount of profit booking. International Gemological Institute, IGI. The numbers were disappointing, and this stock is down 45% since the beginning of the year, 3%, 4% lower today. Across the board, railway stocks are getting hit. So there is a slump on Railtel, Ircon, RVNL, IRFC. Across the board, cuts range between about 3 to 4%. Bandhan Bank is weak in trade. RBL Bank, so select banking names are down in trade. By the way, now the mid-cap index is trying to trim its losses, at least at the headline level. The mid-cap index opened with a cut of 1%. Now it's down close to about 0.5%. The advanced decline ratio is still weak, but at the headline level, some of those losses are getting trimmed. On the way up, you've got a few stocks in the green, and they're moving up on pretty decent volume. So Loris Laboratories is topping the pricing in the volume chart. That's up nearly 2%. Kolte Patil Paytm is a stock opening up in the green. Zomato, very close to the 200 rupee mark on Zomato. The opening should come up for you. NTPC Green, Adani Wilmar, Anupam Rasayan, where there is that LOI. So that's managed a positive start. And oil marketing companies, IOC, BPCL also managing a green tick in the morning. So down. Question is it out or not?
I guess very early. It's very, very early in the day. Let's see. I mean, this pitch is turning. Let's figure out how it goes. The large caps are not seeing any reprieve just as quickly. And what we've seen yesterday is, I think this is a market where you can't jump too quickly. Things change, at the drop of a hat. That's what happened. We were cruising along quite nicely yesterday till about 12:31. And then things suddenly turn. So it is still a fragile market. Sentiment is still fragile. Yet there are bargain hunters which are sort of venturing out there. So let's just wait on it. And see how this transpires.
Today actually will be a good trading session if the Nifty wants to show that it's going to outperform from here on. Maybe we do better than 150 points down by the time we wind up, and we do better than in the broader markets. You see only 250 to 60 stocks advancing. So by the end of today, you'll want the losses to be less than 150 points on the Nifty, and you'll want the number of stocks advancing to be far higher than what we're seeing right now, because Vast is underperformed. We have a couple of tailwinds with regard to the domestic tailwinds, the government spends, the RBI, they've injected liquidity, and also the global tailwinds with the softer dollar as well as, softer crude oil prices. So today is the perfect day if we have to prove that.
No, absolutely. And for me, even if it's a down day, if India starts outperforming, even if global markets are falling, if we fall less, that's perhaps saying something after a long time. But let's take this discussion forward with Dheeraj Agarwal, MD at Ambit Investment Managers. Dheeraj, great to have you with us. And, this is a good morning to have you on as well, because there's so many moving parts, right? Just when we were heaving a sigh of relief, last week was a good week. We stopped falling. Now we have this fresh salvo from the US. And, this is where it's interesting and slightly confusing. We were sort of complaining about US exceptionalism all of these months, and that was the problem, right? The home trade became too good. Now the home trade is faltering. But will it necessarily mean good things for India?
I know there's we want to be hopeful, but I think I maintain the same stance which I have on the channel last couple of times, that I think 25 is going to be a tough year, perhaps 26 also. And it's got nothing to do with the US. US up and down will impact us mostly at the open trade. I mean, last few times US has fallen 1.5%, 2%. We have seen a gap down open of 0.5% to 0.75%, and the closing has been very, very different. So I won't worry too much about whether US is going up or down, but I worry about the fact that earnings growth in our market has slowed down. I don't see any meaningful signs of a pickup going forward. I'm expecting, I think FY26 earnings growth consensus numbers of 12% or 13% for Nifty will disappoint. It will be perhaps below 10. A lot of damage has already been done, so perhaps not too much of incremental damage from here or too much of incremental deep damage from here, but a very dispersed stock price movements, very polarized stock price movements is around the corner, where stock picking and making money is not easy. So I continue to hold that prognosis for the time being. And if US actually goes into a recession, as some people are fearing, it's usually not good news for India.
Dheeraj, you rephrased yourself very quickly. Incremental damage, yes, but not incremental deep damage. So you're worried about earnings slowdown and the possibility that even FY26 could be a high single digit or a single digit kind of an earnings picture. Are you worried about domestic inflow slowing down. You know, there was data which came out yesterday how demat accounts in the month of February have hit a 21-month low. Zerodha has flagged off how volumes after the F&O regulations are down, 15-20%. Tomorrow's Amphi data will be the litmus test. But what is the anecdotal evidence that so far it's been the DII, the retail investors, who've held for, they provided that support. But is there some faltering, flagging off of weakening momentum?
It's possible. I mean, you talk about what is historical data, right? What does the historical data say? That's the best benchmark we can use because it's impossible to predict flows. And if you look at, in fact, our strategy team at Ambit Research, Bharat and team have done this job, have presented a very interesting chart in the previous note, that whenever 12-month returns from the market turn negative, DI flows tend to weaken a little bit. And we are almost there. I think 12-month return is just 1 or 2%. In another month or two, the 12-month return will start looking like a decline or a cut. And that usually impacts the DI flows. Now, I'm not a bear on DI flows. I think structurally, Indian households are still underinvested in equities, and it's a very, very structural, multi-year, multi-decade move. But can the roughly 50,000 crores a month kind of a run rate that we are seeing at this point of time, can it drop down by 20, 25, 30% for a few months? You can't rule that out. I mean, that risk is always there.
Got that. You said it can't be good news in any fashion if the US markets enter into a period of slowdown or a recession or things, reach, I mean, it gets bad over there. So what happens? Suppose, are you expecting a US recession? If the froth in the US comes off, how do you expect India to perform in such a scenario?
So, I mean, whether the US goes into a recession or not, at this point in time, the jury is still out. I mean, frankly, I am not in the recession camp. I'm more in a slowdown camp, slowdown and consolidation camp. I'm not in a recession camp. So a slowdown is okay for India. It's neither here nor there. I think we can trudge along if the US economy slows down. But last 30, 35 years that I've been watching the markets, all US recessions have hurt India as well. But I don't think there will be a recession. I think more likely a slowdown. From an Indian standpoint, I mean, there are two things to watch. One is, as I already mentioned, earnings growth slowdown. Second, more important than US at this point of time is China and Europe. Just remember, a year ago or 6 months ago, people came on the channel and said, where else will investors go? Europe is looking like a museum. China is looking like a graveyard. India is the only growth story in town. Now, suddenly people have options. So Europe is no longer looking like a museum. The new German chancellor is promising to break the fisc and go in for a full-blown reflation. Other European countries are likely to follow. China is at the margin, stabilize their property market. Their tech aid is growing well and challenging the Magnificent Seven in the US, and looking like a investment destination worth considering, at least. I mean, if not very attractive, jury is out again, but worth considering. And suddenly India has alternatives, and there are other alternatives in the world as compared to India. So these headwinds are likely to continue for some more time. And we will perhaps be a choppy, volatile market through 25 and most of 26.
Hi, Dheeraj. You're sounding very, very cautious this morning, but there's clearly some part of the market that you'll be positive on, right? It's going to be a difficult year. We get that. I think the good news from an India investor perspective is that we have underperformed. So part of the bad news is in the price. Last year was very, very slow on the capex expenditure front, which will only get better in FY26. And the hope is, that earnings will improve. And ultimately, earnings is the most important driver for the markets. There's still a couple of pockets as well which are overvalued. But you would be positive on a couple of themes, right? If you could help us out with that.
So actually, I believe this will be a themeless market, right? So whenever markets go into a polarization phase, and polarization simply means that a smaller percentage of stocks will do well and a larger percentage will perhaps struggle or underperform. Whenever we go into a polarization phase, one of the two things happen. Either there are one or two sectors which shine. So like in 2018 to 20 polarization phase, FMCG and a few private banks just outshone everybody else. But if you remember the 2011 to 13 polarization phase, it was very, very stock specific. So I'm actually of the view that we will see a 11 to 13 kind of a phase, where in every sector you'll find winners and losers. So the dispersion within a sector is likely to be very, very high. I mean, if we just look at the last 5 or 6 months as an example, when IT stocks in general have been under pressure, Coforge has delivered 8 to 10% positive returns. And similarly, in many other sectors, you'll find the top performers are either flat or marginally positive, whereas the bottom performers are down 30%. And that's what is more likely to happen, more than the themes. So how do you pick those? One is earnings growth, but more important, predictability of earnings. But the factor which I think will be most important in the market in 25 and 26 will be valuations. So even if earnings growth are coming through, but if the valuations are very steep, one needs to be careful.
Well, those valuations, Dheeraj, just to complete that point, and then I actually want to ask you about something else which is bothering the market today. But just to complete that point in valuation, 15% down at headline index level, 25, 22% down in small caps, mid caps down 20%. Haven't those valuations now corrected to levels which are palatable? I mean, the Indian market's never been cheap in any case, right? So
yeah.
You still find them a little overbearing valuations?
I think so. I believe in market cycles. In fact, I call my investment framework sine curve. And the essential factor or essential feature of the sine curve is that if this is a line of best fit, let's say this is a line of fair valuation, since we're discussing valuations. Valuations will always move 2 to 3 sigma above mean and 1 to 2 sigma below mean. We are approaching the mean at this point of time, and that too only in Nifty. We're not even at the mean for mid and small. But whenever cycles turn, you're likely to see it fall below the mean by 1 sigma or 2 sigma, at least 1 sigma. So the short answer is we're not there yet.
Not there yet. Okay, let me talk about the other issue and, kind of humorous on this one. IndusInd Bank. Now, I'm not asking you for a stock call at all, but I'm just asking you for the events as they've unfolded for a large cap stock. I mean, we're talking about a big Nifty stock here. And the way the market's reacted. Anyway, the market doesn't have any appetite left for, uncertainty, confusion, or nasty surprises. But what do you think is happening here or has happened here with the management extension being shorter than what was anticipated and now this whole derivative issue? How are you looking at the ongoing developments? I don't know if your team covers the stock, I mean, at a research level at all, but this is a bigger question beyond buy or sell.
No, I have no specific comments on IndusInd Bank, but I think you rightly captured it by saying markets at this point of time has no appetite for negative news at all. So it's just the reverse of what was happening till 6 months prior. Negative news would result in a 1 to 2% cut. Positive news would result in a 5 to 15% upward move. And now it's become the opposite. Positive news results in 1 to 2% upward move. I mean, look at BEL, for example. You mentioned on the commentary just before I joined that they received another order yesterday. Stock is up 0.5%. But look at IndusInd Bank is down 15%. So that's purely what the sentiment of the market at this point of time. In fact, I have a very interesting theory that if you actually pick up a newspaper on a daily basis and with a very unbiased form, divide all the news in positives and negatives, for most days of the year, it's 50-50. But when the sentiment is running positive, the positive news is on the page 1, the negative is on page 10. When the sentiment is running negative, negative news is on page 1 and the positive is on page 10. And that's what drives the market.
It's really telling a story today in IndusInd Bank. This is not about the actual numerical impact that's going to play out in earnings. It's a much bigger issue than that. The freeze opened 10%. The moment it opened, next 15%. That's where IndusInd Bank is today. And by the way, on that analyst call, just to sort of jog our viewers' memory, let's pull up IndusInd Bank if we can. 10% has gone to 15% straight away, drop of a hat. Can we get the stock up on the screen? There we go. That's what we're talking about. That's the next freeze. Now, it's obviously an F&O stock. So that flex happens and then it opens and then again 15%. Yesterday, when the analysts asked the management that the fact that Mr. Katpalia got a 1-year extension and not a 3-year extension, does this derivative issue have anything to do with it? He said, and I quote, that this would have had a bearing as that is the RBI, they were aware of the issue. But I don't know what the rationale is to give me a 1-year extension, but I think they're not comfortable with my leadership skills of running the bank. So It was from the horse's mouth. Mark is just very, very nervous. Anyway, all right, we live in choppy waters and slightly uncertain times. Thank you very much, Dheeraj, for joining in. I really appreciate you being with us on the show this morning. So that's a call from our market master. Looking at the market, still down about 0.5% right now.
So let's get chatting and focus zero in on the EMS space. Now, it's been a big wealth creator. Dixon listed, for the last 5 years, Dixon's revenue growth has been about 40 to 45%. Kaynes has had a shorter listing history. It listed only in 2022, but in the last 3 years, Kaynes' revenue growth was about 62% CAGR and the profit growth was about 165%. What does the future hold? Investec recently turned positive on EMS stocks. They're convinced about the growth opportunity in the sector. They upgraded Kaynes Tech and Syrma SGS. They also prefer Dixon Tech and Amber Enterprises. So to discuss this sector in detail, we'll connect with Saurabh Gupta, CFO of Dixon Technologies, and Jairam Sampath, whole-time director, CFO of Kaynes Technology, on the show now. Thank you very much, gentlemen, for joining in. That's the first question, right? The kind of exceptional growth that we've seen in the past for this sector, can it continue over the next 3 to 5 years? And I want both of you to weigh in. So, Saurabh, you start first. I was just checking. Your 5-year revenue and profit CAGR was 40 to 45%. Your ROEs were about 23, 24, 25%. Now, considering that you have expansion plans, you're adding capacity, you're looking at display fab manufacturing for the next 3 years at least, do you think you can sustain this 40, 45% kind of revenue profit growth and maintain your ROEs?
Yeah, good morning. Thank you for having me. So we feel confident that kind of opportunity that we are sitting on, both for the domestic market and now increasingly for the global markets as well. I think so there is no reason why we can't grow by 35 to 40% annually for the next 3 years with more focus on backward integration. So I feel that that will add more strength and moat, and that should also lead to the margin expansion that what we are doing right now. So yeah, 35 to 40% of the growth is definitely doable for the next 3 to 4 years.
And ROEs, can you build on the ROEs from current levels, or do you think the expansion could hurt?
My sense is we have grown from 2,000 odd crores to 39,000 crores, hopefully this financial year. And we have not compromised on the ROCs and ROEs. In fact, those have only gotten better. So like last quarter reported ROC for us was almost 42%. And the initial years we were at 30% kind of ROC. We think that those ROCs and ROEs profile should be maintained. There should be significant cash flow generation, because the businesses where the largest growth for us is happening is basically mobiles and maybe IT hardware going forward. So all these businesses are high on asset turns. And once you focus more on the backward integration, those again will have a positive impact on my ROCs and ROEs.
Jairam, you come in on the next 3-year picture. Now, you're setting up capacities in PCB, OSAT over the next 2 to 3 years. So that's going to be the incremental revenue driver. What kind of a revenue growth are you confident about for the next 3 years, given the visibility and the plans that you have? And throw in your expectation on how margins and the return ratios move.
Yeah, so thank you for having me on the show. I think these questions have been something that we've been battling with ourselves. See, fundamentally, the EMS sector, or ESDM sector, as we would like to call it, is good for maybe around 40 to 50% CAGR without any dilution of our EBITDA numbers. Of course, we need to improve our ROC a tad by improvement of working capital, net working capital, which perhaps will happen with the scale too. Now, the additional sectors that we have forayed into, like the semiconductor assembly and the PC board, is going to be value accretive. And so by maybe about 2-3 years time frame, they will also start weighing in with their revenues and profitabilities, etc. So I think we should be able to see about 40 to 50% CAGR on revenues for sure, without any dilution of margins. And hopefully we would probably also improve the performance of our working capital management so that the ROCs, etc., can be maintained. It's important to say that one thing is to enjoy the tailwind that's already available. The other thing is to also prepare for the future, because we are now looking at beyond FY28. 28 is when we said we'll get to $1 billion. It's a big number for us. And maybe beyond that, we are acutely aware of the fact that within a couple of years, again, it has to get into a higher number. So we are also looking at other beachheads, so to say, to bolster this market So currently, it's obviously domestic driven with a lot of tailwinds and government's stated position of Atmanirbhar Bharat and all that. But over time, I think all of these things are bound to see some corrections. And so we are preparing for a future wherein the geopolitical, let's say, items also come into the agenda, and then we don't want to be taken by surprise. So we are also looking at other beachheads and so on, so that we can maintain this growth of 50% plus CAGR over next 10-year time frame.
Okay, all right. Mr. Jairam, welcome to the show, and Saurabh, welcome to the show as well. Mr. Jairam, let me come across to you first. The longer term story seems to be intact, but tell us, how do you see ordering activity in Q4 so far? And also, if you could tell us about the ordering activity for smart meters. Give us a sense about it. Is it good enough? Is it up to expectations? Has there been some slowdown? Ordering activity, I want to get a sense of pulse on ground.
Yeah, sure. So let me take the second one, the smart meter bit. I think what we see is an acceleration. So this year we might end up with a very good fourth quarter thanks to the smart meters. And next year we'll probably double the number of smart meters that we deliver. So from the perspective of order inflow, that's always been increasing, and the order inflow has been increasing at almost 25 to 30% per quarter on a quarterly basis. So you multiply that by 4. So it's a pretty strong input of orders. And this is after, not really getting the kind of orders that we actually were expecting in some other sectors that we are very strong in. So I think FY26 story will be probably even better than FY25. So we can see, in some sense, we've seen the bottoming out of the, let's say, the growth story. And then I think it's there to pick up. Lots of good things have happened, not just in our ESDM market, but also in our semiconductor and PC board also. The nearer we get to it, we certainly realize that we should have probably done it earlier. So I think the overall, the order inflow, business outlook, all that is extremely good, and it is probably better than what we expected.
What on the PCB project, what is the incentive amount that you're factoring in? And if you could tell us, when does that project go on stream as well?
Yeah, that project goes on stream we'll start getting significant revenues the fourth quarter of coming year, FY26. And we get about 60% total capital subsidies. We don't talk too much about PLIs, etc., because PLIs are visible things, and we don't give much reliance to PLIs. But certainly, capital subsidy is something which helps us to get off the ground very quickly.
Okay. Since we're on company-specific issues, let me just wind that up before I talk about the other global issues. Mr. Sampath, so this delayed orders, I mean, Q3 was impacted by this 100 crore delay, which was supposed to be pushed over in Q4. Are you on track with that? And I think at the end of the third quarter, you said that the year should end between 2,800 to 3,000. Are you still within that ballpark for the revenue?
Yeah, we'll certainly cross 2,800, and we'll do the EBITDA of 15%. We are hardly a few weeks away from the end of the year, so I think that is on track. And coming year, certainly we are a little more careful. Most of the delivery-related issues have been ironed out, and now most of the factories are firing on all cylinders. So hopefully next year will be a little easier. And
and just very quickly, okay, got that. So this year you should be within the ballpark of 3,000, which was your earlier guidance. Got that. And just very quickly, Mr. Sampath, there was some talk of you looking at equity fundraising as well. There was a talk of a 1,600 crore rupee fundraise because you wanted to acquire maybe entities overseas. Where are you on that?
Yeah, so we continue with our actions. So only thing is the fundraise probably got deferred by a couple of months. We thought we'll get the year behind us before we got the approval from the shareholders. So we'll be launching sometime in the coming fiscal. When the time is right and the opportunity window is there. At the same time, we are not diluting on our activities, and we do have a three-pronged strategy. One is geography expansion. The other is getting better strength into the ODM area, and also deepening technology footprint. Because we do realize that all these tailwinds of demand, which is crafted by, let's say, either by tariff barriers or by any other localized demand factors, over time will get equalized, and then we need to be a technology leader. So that's what we are preparing for. This is not required for our $1 billion target, but it's required for doing something beyond 1 billion come FY28.
Okay, so basically that fundraise has been pushed by maybe a couple of months. Got that. Now let me come to Saurabh. And now the bigger question that we wanted some understanding on. I was looking at a note that's come in just yesterday. It's a Nomura note because everybody's trying to wrap their head around the numbers on this whole tariff business, right? So we are obviously importing a lot of the components and duties. India's duties on components have been going down in line with the government's Make in India push, right? All of you have been sort of asking for it, and the government has been doing that. According to these estimates, these are Nomura estimates, our overall electronics exports to the US have grown big time. I mean, they were at 2.5% in FY20, and they're at $11 billion in FY24. So now, if reciprocal tariffs kick in, what happens to the EMS story with respect to the US market? If you could give us some ballpark sense on that and whether it impacts you in any way. I mean, over the weekend, we had Mr. Howard Lutnick. He was all guns blazing, saying, make those, Apple phones in US. Why should they be made in China? He didn't take India's name, but we know those phones are being made in India as well, right? And he was saying that even if the wages are higher, get robots to make them, but make them in America. So with this kind of a mindset, Saurabh, if you could take this up, I mean, isn't this is straight worry for your business?
Yeah, so let me share you my perspective. Of course, yeah, so this is an ongoing thing. The negotiations are going on, as you mentioned. The broad counters are still not out. There has been more still in the discussion phase. But let me give you my perspective. One, of course, India's export to US is $11 billion, and this number will, of course, go up in FY25 as well. But it is still much lower than what China exports. So China's exports, so India's share of electronic exports to US is just 2 to 3%. China is broadly at around 35%. Mexico is somewhere around 22%. So clearly they're very higher as far as the US imports of electronic products are concerned. Now on both the countries, the tariffs have been implemented, and to the extent of almost 20%, which was negligible or nothing in the past years. So we feel that India is at a competitive advantage. So overall, we feel that it will be beneficial for India, because if you look at the overall import duty of on any finished product of mobile phones, it's still 15%, and on wearables, it's around say 20%. But if you look at the overall components as well, components are slightly lower. So the weighted average tariff is still 3 to 4% for electronic products, which is still very low. So now, assuming the Trump is talking about reciprocal tariffs, so either you can put the same tariff on the same product, or you can put a weighted average tariff across a basket of commodities. Now, the basket can be on export and import can be different. So according to that, if that comes into the system, we are talking about 3 to 4% tariffs, which is very low. Now, as far as your question on the manufacturing in US is concerned, we feel that is slightly difficult. Of course, anything can happen, but we feel one, because of the low value addition of the product. Secondly, the wage rate differential disparity between both the countries. So US is almost 10 times more expensive. So we are talking about $1.5 an hour versus $15 in US. Third, the US dollar is strengthening, making the manufacturing more expensive. So we feel that seeing in light of all these factors, India is slightly in a better position. But of course, these things also, we are living in a dynamic world. So this tariffs needs to be sustained on China and Mexico for the supply chain to shift.
No, Saurabh, sorry, just trying to come in to understand right now, what is Dixon's exposure to the US, if at all? Total revenue, what is the export element to the US, if at all? And then if Mr. Sampath could tell us the same. Saurabh?
So for us, it's a very small number. Last year, it was out of, it will be broadly 5% of my revenues, mainly for my anchor customer. But the same anchor customer is now talking to us for larger export quantities to US in light of the tariffs which have already been levied to our neighboring country, on our neighboring country.
And you don't think that's at risk? Will that anchor customer, US anchor customer, continue to look at sourcing large volumes given, the sort of the rhetoric and the reality in the US on tariffs?
So my sense is we feel that we will be at a competitive advantage as compared to China, even after this reciprocal tariffs come into the system, which will not have much of impact as what we think. As far as electronic products are concerned and smartphones are concerned.
Saurabh, Jairam, great conversation. More to ask, but we're out of time. But thank you very much for joining in on this discussion on tariffs, the long-term picture, the near-term, and so much more. Get into a break. On the other side, we'll connect with Nazara Tech Management as it's divested nearly 95% of its stake in Open Play Technologies. Welcome back. As promised, let's invite the management of Nazara Tech. The company has completed the open place sale for nearly 104 crore rupees to Pokerbazi's parent Moonshine. To know the rationale behind this development and the outlook, Nitish Mittal Sen, joint MD and CEO of Nazara Tech, is here with us on the show. Nitish, thank you very much for joining in. First, give us the rationale behind this and how does this divestment align with the company's long-term growth strategy?
Sure. As you know, a few months back, we had bought a significant stake in Pokerbazi, which is India's largest online skill-based poker platform. And the thought of, selling the open play stake to Pokerbazi is really to consolidate our real money gaming businesses, the skill game businesses under one vertical. The Pokerbazi team is extremely strong, very strong on technology. So we believe that consolidating the RMG business within them makes more sense for us.
How big is the RMG business now for you in terms of overall size? And considering you've always been bullish on it despite all the regulatory headwinds, what is the aligned vision for your real money gaming business under Pokerbazi now?
So Pokerbazi being the dominant player in that space, in that vertical with over 60% market share, is run rating at about, I would say, approximately a net revenue run rate of 600 crores plus. And, will continue to grow very well for us. So the whole idea is that any other vertical of RMG, whether it is open play business or casual gaming, skill-based casual gaming, all of those combined would provide a lot of network effect and, lower cost of acquisition. So logically, it makes sense for us to kind of concentrate at one area and, focus all our RMG businesses over there. That's exactly what we have done. And I think this will be very fruitful for us.
Is there going to be any other intermovement of your businesses or has all the RMG been consolidated under Pokerbazi?
I think RMG has been already consolidated.
Okay. And what is Nazara planning to do with 104 crore? I know you're very cash rich. What's the current balance? And now with this incremental 104 crore rupees, what are you planning to do?
Yeah. The balance is quite dynamic because we've been very active in, a lot of investments. We recently announced an investment in a very interesting startup called Real Saga. We've also placed a pref which is still to close for about INR 495 crores. I think that money will come in the next month or so. But our primary objective will remain reinvesting in organic growth as well as, acquiring interesting companies. Our current focus is on the gaming studio businesses like the ones we've done in the past. And I think in the coming months, we will make more such acquisitions.
What is your current stake in Moonshine? Who are the other stakeholders in Moonshine? And how is the valuation arrived at?
So we hold approximately 47% stake today, but we also have, a CCPS note, which we can convert at our, will to, consolidate this business and increase, over 50%. So we will do that at the right time. The other investors largely are the remaining stake is largely owned by the founders.
Okay. And when are you planning to convert the CCPS and at what price? And then your stake would be 51%.
Yes, I think we will, look at it maybe next year. We're not in a very big hurry on that front. We want to give enough room to the team to, grow the business aggressively. At the right time, we will do it. We don't have a specific timeline. But yes, once we convert it, it will be over 50%.
No specific timelines right now. You had earlier indicated about a 10% kind of a revenue growth for FY25. Does that still stand? And you must have drawn up plans for FY26.
Yeah. If you saw our Q3 numbers, right, which we reported in February, our revenues grew year on year for that quarter 66.7%. And our EBITDA actually grew 39%. We posted our highest ever EBITDA of 52.4 crores in Q3 FY25. And this EBITDA is backed with very strong operating cash flows. So I think, we're on the right track and we will continue to deliver healthy growth, in the quarters to come.
And what about the advertising and promotion? That had seen a big jump in Q3. Are you going to continue to press the pedal on marketing? And what's the number as a percentage of sales?
We're seeing very good traction on some of our games internationally, especially west facing into the US. And because these are very profitable spends, obviously, if we can continue to grow it, we will continue to grow. So we don't have a specific target in terms of percentage of spends. The idea is we will continue to scale as much as we can.
And FY26, Nitish, you didn't give us is there a growth number? Is there a top line that you're targeting, margins?
We're in the process of finalizing our AOP right now for the coming year. But I can definitely say that we will be looking at, much more aggressive growth in FY26 over what we have delivered in FY25, both in revenues and profitability.
Aggressive growth in FY26 on revenues and profitability. So we should brace ourselves for margin expansion.
Yes, that's always a focus for us.
Always a focus. In the prior quarter, there was also this one-time impairment on brand scale innovation, wings as you called it. Any such, because we've seen a slowdown in the market, not particularly where you operate, but generally many of the smaller companies are struggling to grow, etc. So are we likely to see any more impairments?
No, I don't think so. All our businesses are working well and are profitable. We are generally a very conservative company and like to clean up our balance sheet, quickly, and which is why we kind of proactively took this impairment of Wings. There is, as we had disclosed in our presentation, also there's an outstanding loan to Wings, which may get provisioned at some point of time, maybe this quarter or next quarter. But generally, we have a very clean and healthy balance sheet.
Nitish, thank you very much for joining us on CNBC-TV18. That's the word coming in on Nazara Tech. For the Nifty, it's down 85 points. The Nifty is at 22,375 on the way up. Sun Pharma, which made an acquisition yesterday, Checkpoint, is up 2.5%. Top gainer, ICICI Bank, comes in for buying. And then there is this full consumption FMCG tilt in the market. Buying emerging in Nestle, Britannia, ITC, HUL. These are stocks where you can see green on the screen. But the problem is IndusInd Bank opened with a 10% downtick, now down 20%. Abhishek is now joining in with more.
Well, Rima, to begin with, internal review process that they have had with respect to asset and liability accounts of derivative portfolio over there, a hiccup has been seen. So about 2.35% of the net worth will get adversely impacted. So it's about 1,580 crore post-tax or about 2,100 crore pre-tax. So they have appointed an external agency to review and validate the internal findings with respect to what has gone wrong. The bank's profitability and CRAR, that is capital adequacy ratio, remains healthy to absorb this one-time impact that they will have from this portfolio. So management in con call did say that the practice has been ongoing for 5 to 7 years now and was discovered as part of a review initiated following new RBI guidelines effective 1st of April 2024. The RBI has been fully briefed on the issue. Initial and final updates have also been provided to RBI. They also went on to say that the CEO's 1-year extension versus 3-year that was sought by the board of the bank acknowledged to be influenced by the issue. So analysts do say that this is a one-time earnings impact but can lead to short-term de-rating of the lender, that is IndusInd Bank. So they have cut earning estimate anywhere between 20 to 25%. Many of them have cut their target price as well, like MK, Jeffries as well as Citi. In fact, MK has downgraded the stock recommendation to add from buy. Now promoters holding is around 16.3% in the bank. So about 50.9% of it is pledged. So we need to be careful or watchful of that as well. Back to you.
Biggest single day fall for IndusInd Bank since March of 2020. That's COVID time. And now the stock is at its lowest level since November of 2020. Thank you, Abhishek, for that. It's over to Vamakshi now for Star Health.
Well, Rima, Star Health is under pressure today, and that is because Ahmedabad hospitals and nursing homes have suspended the cashless services for policyholders of 2 insurance companies, which include Star Health as well as Tata AIG General. Now, these cashless services will not be available for policyholders of both of these insurance companies starting from April 1st. And the reasons the hospitals have outlined for the same include unjustified deductions, low charges reimbursed, non-renewal of tariff rates, as well as one-sided blacklisting of hospitals. So given this development, the stock, that is Star Health, is reeling under pressure as of now.
Thank you very much for that. Nifty IT index is down 1.5%, feeling the heat from the 4% Nasdaq fall, but Persistent is still up in the green. Sudarshan is joining in, tracking the upgrade on Persistent and Escorts Kubota.
So while following the market trend and global cues, Escorts Kubota and Persistent are down in trade today, but CLSA has come out with a positive note on both these stocks. CLSA maintains outperform call on Escorts with a target price of 3,805. implying an upside of more than 25% from current levels. And CLSA has come out with a note, and it's after the CLSA has met the management of Kubota Japan. What did it say? That Kubota Japan remains positive on growth outlook for Indian farm industry and expects growth in the range of 6 to 7% even for FY26. Do remember that companies have been saying that for FY25 also growth for the tractor segment is seen in the range of 6 to 7%. So if in FY26 also growth comes in the range of 6 to 7%, it can be seen healthy. Also, it says that company expects to gain market share with the launch of Farm Track brand, and current market share is around 11.5%. Now it expects to rise to 13% in medium to long term. Second is CLS on persistent. It has upgraded to high conviction outperform, and target is 9,267 per share. It says it sees AI is sparking a new tech cycle, and it's going to benefit most of the IT company, and that's the reason it has upgraded persistent.
Thank you very much for that. There is a small recovery underway. From being down to levels of 22,314, the Nifty's managed to recover nearly about 100 points, so trimming its losses and now above 22,400. Get into a break, but don't go anywhere, because on the other side is our market editor special, one of the biggest bulls in the India story. Morgan Stanley's India equity strategist Ridhim Desai is our market editor.
Oh, okay. He's got a...
Where is cam 3?
I got
the jib. Then, but should be written such a big lead in for result.
So that's what, no, now see, now jib is there.
Okay.
We have to read from that camera, which is next to the jib.
Okay.
So he will follow wherever the jib goes. Yeah.
Cool.
And we're in the bazaar show queue?
Yeah.
Just for reference. We're in F rundown.
Lower the chair's height. No, I can't.
A 5-month-long correction that has shaved between 15% to 25% of the key indices here in India, and it has led to deeper cuts in the mid and small cap universe. For many Indian investors who are used to extremely shallow corrections since COVID, such a prolonged period of Indian underperformance has really been a bit of a bolt from the blue. Over the last 1 week, the selling has abated to an extent, but then sentiment as well as recovery are still very, very fragile, Nigel.
Well, that's right. The Nifty has recovered close to around 2 to around 3% from the recent lows with regard to that correction, but it's still 14% away from the peak. The problem is the mid and the small cap indices, they are still nursing steep losses, which are in excess of around 20 to around 22% odd. The market is now showing some signs of returning to form as valuations, well, they're a little bit more palatable. Crude and the dollar as well have cooled off, which is a tailwind from an India market perspective.
So the question is, that's the question we are going to ask to our big special guest on the show today, is the worst over? Are we finally seeing light at the end of the tunnel? Hello and welcome to this very special conversation, Market Editor. Today we have with us one of the biggest bulls on the India story, Morgan Stanley's India equity strategist, Ridham Desai. Now, as we start this conversation, we must tell our viewers that Ridham feels that Indian fundamentals are actually improving. It's not that bad out there. And he feels that the markets could be at a turning point in this, time of 2025. Ridham, it's such a pleasure to have you with us in person in the studios. You know, any morning is a great morning to talk to you. This one is even special because look at the backdrop. We have so much masala to go over. Thank you so much for joining in.
My pleasure. Good to be back.
So let's actually start right there. Right? So much pessimism. 5 months of a correction. This is a market that was about 3% correction. Ko correction bolte hain pe. That's what happened, right? After the COVID rally. Now where we stand, there was this whole talk of US exceptionalism. That's my first question to you. So we were upset over the last several months because of US exceptionalism. Money was going to the home market. Now, last 2-3 days, it's become very apparent that exceptionalism is being questioned. So does that feed in further into your narrative, which is anyway very positive on India?
So I think India put a peak at the end of September last year. And the genesis, the idiosyncratic genesis of the peak, so leave aside what has happened in the world, which is a lot, and it's very complicated, was the fact that India's growth was slowing down. And this growth slowdown, in my view, was triggered by policy tightening. The fiscal deficit was compressed in the trailing 12 months by about 120 basis points, from 6 to 4.8. We're still finishing that financial year. And a lot of that compression happened in the first 6 months of the year, due to very specific factors like elections, heavy rains in August, Shraddh getting advanced, etc. And it got compounded because the RBI was also, I think, quite stringent with its policies. And leave aside rates, liquidity was tight, and the regulatory overburden on the banking sector had gone up. So we arrived in the last quarter of last calendar with credit growth slowing from a peak of 16 to under 11, and government spending really slow. So the quarter produced bad earnings, and stock prices took it on the chin. Now, at the same time, something I underestimated in terms of its importance was that China inflected in terms of policy. And this 27 September is the day after China's fiscal policy changed. And a lot of commentators said that, oh, no, this fiscal stimulus is investment-oriented, China needs consumption, but it marked the bottom on the Chinese markets. At a time when India was constraining its fiscal and monetary policy, China was actually getting more dovish. And we've had very steep underperformance, which is not visible in your headline numbers, between India and China. A complete reversal of what we had seen in 23 and 24. Yeah. So India is back to where it was in 23 relative to China. And India's growth rate is much better than China, even today, even with its slower growth rate. So the relative adjustment has been very sharp. Now what has happened is that we saw in February a policy pivot, which I will say is one of the biggest in my career, going back 35 years. The RBI has put a three-pronged correction, cutting interest rates, committing itself to liquidity, and also starting to lift the regulatory burden on the banking sector. The government's fiscal contraction continues, which is absolutely what they need to do. because you have to prepare the government's balance sheet for the next potential crisis when and when it happens. So you have to use good times to rein in. And this is also very good for medium-term earnings. I'll come to that in a moment. But the pace of fiscal consolidation is going to be a lot slower in the subsequent 12 months. Only 40 bips on 4.8 versus 1.2% on 6. So it's halving. And at the same time, and that's why I have termed this budget as a magic budget, the government's capex as a percentage of GDP is going up from 4 to 4.2. And they're achieving this very favorable mix by constraining subsidy spending, which, by the way, in this budget hit near all-time lows. So it's a very sweet budget for the market. The RBI policy is sweet. The market has just ignored this, what I call as policy pivot. You could put the chart up there. The policy uncertainty for India, the uncertainty rose into the end of last year, and then it has had this V-shaped recovery.
From an RBI perspective, you're saying?
From RBI and from government perspective, India's policy environment today is far more certain than the rest of the world put together, whether it's US, Europe, or China. So you want to buy this policy certainty, and I think investors will buy it. Our retail investors get it, and I suspect that February may have been record inflows. And a lot of people have been quizzing me about when will retail give up, and I've got tired of saying this, they won't.
Getting the data tomorrow. And
yeah, you will get the data tomorrow. I won't be surprised if it's a record high or near about there. Retail is not going to give up because this is a shift in the balance sheet allocation that got underway in 2015. Again, because of a major policy shift, and I'm digressing a bit, when the Prime Minister's allowed retirement funds to buy stocks, that is Provident Fund and NPS, which was very similar to what Ronald Reagan had done in 1980, when he allowed 401k plans to buy US stocks. We got a 20-year bull market in America, which ended with the Nasdaq bubble. And it ended because a lot of baby boomers started retiring, and they had to take money out of the markets. Yahan pe nobody's retiring in 20 years. This has got many more legs to go. So the retail bid is persistent. Nigel, you mentioned oil prices are down. That helps. It's not a major game changer for India as it used to be in the past, because the oil intensity of our GDP has halved in the last 5-7 years. Again, due to major structural reforms that the government has taken, electrification of the railways, faster highways, FASTag, GST, I can go on and on. Yeah. But for those who've been long enough in this market will remember that 20 or 25 years ago, one of the quintessential trades in the market was to buy diesel genset companies. Nobody is using diesel to fire up electricity now. Yeah. Electricity is on the grid, and almost every household in India has electricity. So our consumption of oil versus GDP has more than halved in the last few years. So that
sensitivity to oil prices.
The sensitivity to oil has broken down, but yeah, I will take 65 on oil. Yeah. And we have the DXY, which was a source of pain. So what you should see is the real effective exchange rate. And the rupee was doing very well in December, even though the headlines would be it's going down, but on a relative basis, it was doing very well. The RBI was defending it. But since then, the rupee has gone down by 6% in real effective terms, and it's now at levels that we have not seen in a while. It will go back all the way to 2017. So there's a big correction that has happened in the currency markets. The most important thing, and don't look at what equity investors are doing, look at what bond investors are doing. $900 million of inflows 2 weeks ago, last week $2 billion. FPI debt flows have turned like this. Right. They are suggesting that the rupee has now reached a level where they don't expect much more in terms of downdraft. In fact, if anything, probably an appreciation. And I think that is a very important change that has happened.
Okay, all right. Rhythm, taking all those points on board, and the last time we spoke, you were talking about this budget being a magic one. Unfortunately for the equity markets, the reaction has been tragic. Right, because the markets didn't really take that in its stride. That said, one of the big reasons is because of the FPI outflows in the equity markets. And that's getting very, very aggressive and excessive, one could say, with their holding at multi-year lows. What's your sense? Earnings are going to return. We have CAPEX spends that's going to pick up. And, the tailwinds in the lower crude price as well. Do you think they're coming back?
Let me try and explain this for the 500th time. There are only two cohorts in the market, domestic investors and foreign investors. You can break domestic down by institution, retail, you can do all those things, HNIs, you can do lots of breakdowns of those, but let's keep it simple, two cohorts. Even foreign portfolio flows can be broken down into many categories. Now, every morning, 9:15, this cohort on the right-hand side, which is domestic, is putting its bid in relentlessly.
Yeah.
How can this guy buy? Can't. Because you can't get a trade in the market if there are only buyers. Somebody has to sell. So I've tried to explain this, that the only time foreigners can buy is one of the two happens. Either domestic starts selling, they won't at these levels. You put share prices higher, they will. So foreigners will have to pay a lot more to get in. Or the third player comes in, which is corporate issuers. Because net inflow into the market is what you get in terms of issuances minus buybacks. So that is your net inflow. So if corporate issuances take off, then foreigners can buy those issuances and they can participate. Otherwise, expecting that foreigners will buy without domestic selling ain't happening. It is just not it's not practically possible.
Right.
Which is what we actually saw for a lot of early, late 23, 24, because that was the block deal buzz, right? Nimesh would come every day, talk about the blocks and the QIPs.
A lot of issuances
primary
took place
issuances.
In 24, last quarter, if you look at the issuances on an annualized basis, it was about 2/3 of the previous peak.
Yeah.
And that was when foreign investors could buy.
Yes.
Yeah.
Once the issuances faded, their ability to outbid domestic is constrained.
Yeah.
You must understand that those who are 8,000 miles away from India understand India a lot less than those who are sitting 1 mile away from the stock market. So this was not the case 10 years ago. 10 years ago, the only buyer in India was foreigners and domestics were persistent sellers.
Yeah.
Retail took its holding in the market down from 27 to 8.
Yeah.
That's how intense they were so scarred by the scam of the early 90s that a whole generation lost, exited the market. This is very different now.
Yeah. But Rhythm, to come back, actually I'm coming back to the opening question with this. We completely take your point on the fact that how can FPIs buy if there's no seller in the Indian market? That point is well taken. But isn't it true that the last 5 months were also about realizing that India is not the only game in town? There was that US exceptionalism trade playing out, right? It was like the US economy and the US market could do no wrong. It was that tech trade playing out. Like you mentioned, there was China as well. China started grabbing attention as well. So from that standpoint, are we now better placed? Because US seems to have its own issues. China, we don't know. There's a lot of stimulus there, but we don't know. But from that standpoint, when you sort of hear global chatter, is it relatively looking better for India?
So the exhibit to look at, if you can put it up on the screen, is the relative valuations that India has versus the world. Foreign investors, the biggest problem they had was with respect to the price that they were paying, valuations. And India's valuations versus the world were like this. They've collapsed.
Yeah.
We're now a stone's throw from the bottom hit in COVID relative to the world. So we're very attractively valued.
Okay.
And at the same time, if you look at consensus earnings, and I am more bullish than consensus, I think growth is going to surprise to the upside because of the pivot in the policy. But let's take consensus. I have the consensus estimates for the world, rest of the world, and for India. That has actually made an inflection in the last 2 weeks.
Oh.
Yeah.
Relatively. Okay. Not because Indian earnings estimates have gone up, because world earning estimates are going down faster than India. So on a relative basis, India actually looks much sweeter than it has in many months now.
Yeah.
This is not just about the last 5 months. India was looking stretched for a long time into this. And foreign investors had cut back. Now, if you look at the foreign portfolio position in India, they are the most underweight they've been on Indian equities ever. I have data for 25 years. And the last time they were underweight was in 2007. And they've been overweight all along, and they've been cutting that overweight position for the last 10 years. They've been net sellers in the last 10 years because domestics have been buying. And now that underweight position has gone down to levels we have never seen. So Yeah, foreign portfolios exposure is low. Indian valuations on a relative basis looks better. Indian growth on a relative basis looks better. Policy is more certain.
Yeah.
And most importantly, India is now a low beta market, unlike the past. So
Yeah.
if you go back 10, 15 years, India used to be a market which had a beta of more than 1. And for your listeners, that means that India used to go up or down a lot more than the world. Now, if the world is in a trickier position than it has been for many years, the likelihood is that India will outperform. It's a India is like consumer staple stocks. It will outperform a bear market in the world. So it is quite attractive at the moment.
So 12 months down the line, if you put in a level for the Nifty, I mean, you're clearly sounding very, very optimistic with regard to the prospects, all the data that you put on board as well. The FI is underway. The retail, you're not worried about. I'm part of that, and I'm telling you that I'm keeping the money going in there. But, you know, what kind of return should we be looking at on the headline index from here on, post that 15% correction?
So, Nigel, I was chatting with one of our larger mutual fund distributors, and he happened to meet a lot of institutional investors, and he said, you know, these guys are not going to make money in India. And I said, why do you say that? Oh, because their time frame is 1 month to 3 months. He said, my pool of investors, which is the retail guys, they come in, they put the money and go to sleep. So don't ask me for a 1-year view. The thing is that it is very hard to time the bottom. I know Surbhi opened the show by saying, I think it's a bottom. I have no idea whether it's a bottom or not. What I know is that stocks are looking attractive. And in time, this may prove to be you know, a good time to engage. There's a lot of uncertainty around. It's a lot less than the uncertainty we experienced during COVID. But during COVID, one of the things I had read in my life, which was of great use to me, was that the point of maximum uncertainty is also equal to the point of maximum return. So we may not have maxed out on uncertainty. Maybe it gets a bit more uncertain in the next 4 weeks or 5 weeks. But as it gets more uncertain, the point of maximum return is coming in. Now, I'm not trying to avoid your question. The challenge of answering your question is that you have to put it in the context of the world. So I have no idea what the SPX is going to do. I have no idea what China is going to do. I think India will beat these markets.
India will outperform from here.
And I think small and mid caps will do quite well into the next few months. Maybe they go down first a little bit more before they turn around, but it's very hard to catch them.
So India outperforms many emerging markets from here on, and the breadth of the market, the broader markets will outperform from here on.
I think India outperforms the world at large.
Okay.
Including the US markets from here. And I think, yes, mid and maybe from a sectoral perspective, you've not asked me, but financials are doing well right now. I think they'll lead this market out of its problems, and then it will transfer to consumer and industrials and other sectors.
Those are your 3 key overweights as well: financials, consumer discretionary, and industrials. And that SMID call is very interesting. It's an anti-consensus call, right? While the world is saying go buy large caps in India, Rhythm is still very, very bullish on the small and mid cap space. Well, we do have.
It wasn't last year, and I was wrong because SMIDs continued to outperform, and it took a while for that trade to unravel because SMIDs did look quite rich for most of last year, but they just continued relentlessly and then went into excessive valuation territory. But I think we've come out of that now.
Okay, so Smith's also looking good now. Got that point. Well, we do have to take a very, very quick break. But on the other side, we engage with some of the companies from some of the sectors that Rhythm is very, very optimistic on. As market editor, we will get you his interaction with Mr. H.M. Bangur of Shree Cements. Join in for that conversation in just a bit after break.
Hi, Mr. Bangur.
Hi.
Nigel here, sir. Good morning.
Yes,
Thanks a lot for joining in.
Thank you.
Rhythm has got a couple of questions for you, so he's with us in studio.
Okay.
I'll ask you about the cement market.
Naturally.
What you're seeing and prices. And then maybe some...
Yeah. Mr. Bangur, also if you could give us some color, because if I'm looking at the amount of cement that's moving by rail, that's a little confusing. It's been going up and down, but otherwise government capex spend is good. The real estate companies are saying that they're consuming big time. So what do you see? Are we bracing for high single-digit growth? If you could help us out with that. Will ask you the question.
Definitely growth should be good. And
we're coming to you, sir. We're coming to you. We're in a break. We're looking forward to having a chat with you. It's been a while.
Thank you.
Welcome back. We have a very special guest with us in the studio, Mr. Rhythm Desai. And joining us now is Mr. H.M. Bangur to help us out with how he's seeing the trends shape up in the cement space. Hi, Mr. Bangur. Well, Rhythm has plenty of questions for you. But before that, I just want to push one across. I'm looking at various high-frequency data. It's getting a little bit puzzling with regard to the amount of cement that's moving via rail. That data has been up and down. But otherwise, the trend on ground, we understand, is quite good, with the capex spend picking up, as well as housing companies. They say that demand's good. What are the trends you're observing right now? Demand as strong as expected?
Demand is very good, and it should be 7 to 8% growth for this year as a whole, calendar year as well as the financial year. There is shortage of housing. The housing companies are able to sell all of their material. Their stocks are coming down. Government infrastructure, which was weak in the last year, they were not able to spend their budget. Now, for the last quarter, I am seeing that from January onwards, it is picking up, and it is expected to remain so for the whole year. So everything, positiveness is there. Nothing to be afraid about the market size or market growth or demand.
Sir, Rhythm here. Thank you for coming on this show. Could you also give us a little bit of comments on pricing? We are seeing divergent trends. East and South have been weaker than North and West. Are there any specific reasons for that? And how do you think pricing is evolving, particularly in your key markets?
Pricing will be depending on the demand supply. As I was saying, the demands are good. Only where somewhere in the north, so much capacity has not been added. So in north, even after full production by everyone, we are finding that the demand is still more. We are not able to meet the whole demand. So the price rise is very natural there. And in south, still the overhang of the capacity is there. Now the market is behaving very naturally. So west will be, because of the high prices, because of the logistic cost as the material is coming from south. The costs are high, the prices are high, but the profitability will be only normal, not very high. The profitability, good profitability is there in the north only at present.
Okay, question on demand that Nigel asked you, a little bit more detail on that is, have you detected any change quarter on quarter? You mentioned about the slowdown in government capex. Now, government capex, we know, started picking up in October. So has that changed the tone on cement demand, particularly going into 2025, Jan, Feb? Are we seeing some different trends?
Definitely, yes. This year, every year, January, March is the last year to spend the remaining budget. The government expenditure is on a very high. In the March month, Holi is there every year, and even with 2 to 3 days less working, the demand is the highest, much better than about 5% demand high, 6% demand high on a daily basis in March. So, as I see, the demand will remain good. Now, the momentum for infrastructure projects are picking up. About 60% of the demand is housing. So, housing, as we all know from the other sector, that housing stocks of the flats and the residential units has come down sharply. So, there a lot of construction is needed, and infrastructure will be there. The 10% is other demand that depends on industry and others. So that is okay. So we are very happy about the whole situation.
Sir, are you seeing any weakness because of the stock market in real estate? Because there are a few people who are thinking that maybe this stock market weakness will now reflect in real estate demand as well.
These are blips. We cannot take them as a trend. Something will always happen and it will have some impact. But it is a continuous money flow. In fact, I can say that as you wants to read it, money will not flow into the equity market and then it will have to flow into the real estate market. These are the two big markets where you can park your money. So I feel those are outliers and not have much effect except for discussion. If the money is there, Indian growth story is intact, and so much money is chasing that everything should be in a good atmosphere.
Sir, one last question from me. How do you see the trends in consolidation? The cement market, I used to cover cement 30 years ago, was very fragmented, and we have had years of consolidation. Do you think that's over, or there will be more consolidation in the next 5 years?
Definitely more consolidation will be there. Who will be selling, we don't know. Because when you consolidate, overall the cost comes down. The logistic cost for everyone will come down. Production cost will come down. It is good for the country also. It is good for the industry also. So there will be sellers, always sellers, and consolidation will always happen. What has happened in last 2 to 3 years, the same momentum may not continue, but still it will be a much higher momentum compared to the past.
All right, Mr. Bangur, you said that you don't know who will be the sellers, but that could be sellers. The question to you is, will you be a buyer? Because actually in this inorganic market, you have been absent.
No, we are absent because we are having our growth story very calculated. We are not going for the sudden impulse. And if something goes cheap or at the right price, right now, even in the new industry, when we are putting a new unit, the return on sales may be 25% or so, which is being seen. But return on capital employed will be 7 to 8%. That's all. So when I want to buy at higher cost, you have to have more waiting period. Ultimately, this 7% because of inflation and others